Life, lessons, logistics. Let's go. Good afternoon, everybody. Welcome to the Storytelling Chronicles. I am the Bodacious Cowboy, and I have my friend here, Jason Miller, professor of supply chain from the University of Michigan. Welcome to the show, Jason.
Hey, thank you so much for having me on.
Yeah, anytime. I look up to you. I look at what you post out there. I look at a lot of different resources, and I particularly like a lot of the things that you put out there for people to, take a look at and make their own judgments. Tell everybody about who Jason is.
Yeah. So again, thanks for having me on. So kind of his background, I'm right now the interim chairperson for the Department of Supply Chain Management here at Michigan State University's Eli Brogue College of Business. What I primarily teach is graduate level, so MBA and doctoral level as well. And really sort of, what I do a lot of engagement with industry. One of my specialties is essentially taking a lot of government statistics, especially as it pertains to manufacturing, retail, wholesale, prices, and other logistics related topics, and really trying to translate that over for folks in industry who aren't trained economists or trained statisticians to just provide some additional data and insight as you're thinking sort of big strategic level decisions. So as I'm sure we'll talk about today, is capacity exiting the trucking market right now as we're in a freight recession? Well, there's some data that says maybe, there's other data that points a different picture. So what I try to do is help folks just translate all of that over and deal with a lot of the uncertainty that exists out there, because one series says this, one series says that.
Yeah, and a couple of weeks ago, you mentioned, correct me if I'm wrong, that you didn't see any real boom in any one vertical of the supply chain that would indicate this is where everything's going to go. And then this morning I read, that you saw an uprise in automotive, which I thought was pretty interesting. So what do you see, today and moving 3 months from now?
Yeah, so if you look at the auto sector in the U.S., and obviously so critical from a freight generating standpoint for both trucking companies as well as the railroads, it's been one of the most resilient sectors of manufacturing as we've moved into the back half of 22 and now through this first half of 2023. A big reason for that is there's such a cumulative shortfall of vehicle sales that didn't happen in 2020 and 2021 and 2022 due to the initial COVID lockdowns and then all of the part shortage issues, the semiconductor issue being sort of the biggest one. And so even with interest rates and car loans being over 6%, even with the average payment being something like $700 a month, we're still seeing sales right now of new light trucks, SUVs, minivans, et cetera, tracking basically where they did in 2018 and 2019. And so that has been the one sector that has really sort of held up, whereas we've seen things like paper products and wood products show very steep declines really since about the middle part of 2022.
Yeah, when you mentioned semiconductors, that's been an issue for quite some time. And it pretty much evolves around what happened at Fukushima, right? And when a particular company, no need to mention names here, put all their eggs in one basket, and unfortunately, they weren't able to feed the supply chain. And you know what happened after that, and now people started thinking about nearshoring, trying to get that product closer to the end user. What are your thoughts on that? And what do you think that can be done to correct that? Because it just seems to be an ongoing issue.
Yeah, so I'm what I would like to say is a nearshoring either realist or possibly even a little bit of a pessimist. And this is just because you have to take a big long-term perspective.
Right.
If you look at semiconductors, in the late 1990s, we had about 230,000 individuals employed at semiconductor plants in the United States that were making chips. Today, that number is a little bit over 100,000. So we have half the employees. While we're seeing the chip plants going up in Ohio, we're seeing them going up in Arizona, Texas, expansions in New York. It will take us decades to get to where we have the capability on a global scale that we did 30 years ago, because we saw so much fabrication work move overseas.
Mm.
On the broader reshoring, sort of narrative, I'm very skeptical that a lot of the products will come back even to the US or more likely to Mexico, just because the parts ecosystem for so many different products exists in East Asia, and especially it exists in China. And so now that we've started to see, all the log jams have cleared on the ocean shipping side. If I'm a furniture wholesaler and I'm thinking about sourcing, basic furniture, I'm not going to come back to the United States. Our mega furniture factories closed with the onset of the global financial crisis. Those are gone. High Point, North Carolina is never going to have these facilities with 5,000 employees and a furniture manufacturing plant. Do I move to Mexico and have to set up an entirely different supply chain for some benefit of shorter lead time versus the ecosystem already exists in China? I think that will become a much harder narrative for supply chain professionals to sell to their corporate financial officers and the CFOs as we start thinking, about 2023, 2024. So while we are spending more money right now on building new plants in the United States than we have in the history going back to the Census Bureau data back to the late 90s,
Mm.
I'm still not convinced there's going to be that much of a shift. Maybe it's 1 or 2% more freight volume as a result, but certainly we're never going back to manufacturing employment like we had in the late 1990s before the offshore input.
Yeah, you mentioned about furniture manufacturers going south. How about the one in Alabama? I forgot the name of it, and they all got a phone call or email at 1 o'clock in the morning saying we're closing down shop after being in business for over 90 years. A ton of generations. Imagine getting that phone call. So I do agree with you on that for sure. What about India? There's so much chatter about India. You have Mexico, China, Asia. Now you're talking India, and there's so much. It seems to me, anyway. And correct me if I'm wrong. A lot of focus in India. What are your thoughts on that?
So I certainly think you'll see some production move to India. There's obviously a lot more business challenges with India versus China. You don't have the same efficiency of the logistics system. Again, that parts ecosystem, if you're now having to ship parts from suppliers in China to India for final assembly, it makes that decision look a little less attractive, which probably explains why I think Thailand and Vietnam will be the two biggest direct beneficiaries in East Asia from the move out of, at least a little bit out of China. Is I think what that means, if we do see a move to India, for trucking companies in the US, that's a win for the Gulf and East Coast ports, and that's a loss for the West Coast ports, because the vast majority of freight from India goes Indian Ocean, Suez Canal, Mediterranean, Atlantic with an East Coast onload or offload.
Yeah, and with such a decrease for many months now coming out of Asia with vessels and shipping volume, when do you think that's going to turn? I mean, it's not where it needs to be. Pricing is dropping through the floorboard, sort of speaking. What are your thoughts on that?
Yeah, so I think when we look right now at import volume, and we get a little bit more data actually coming this week for the April data from the Census Bureau for imports.
Hmm.
And so what I'm seeing right now is we've seen about a 15-20% year over year decline. But that's falling back to essentially 2018 levels, 2019 levels. So we've essentially sort of reverted to the long-term mean that existed before, maybe a little bit down compared to a trend line would be, because we still have some sectors like building materials, retailers still have too much inventory. So as I look at it right now, is we're essentially regressing to the long-term trend, likely with sort of muted volumes a little bit, because there's just so much uncertainty from the wholesaler and retailer standpoints about where, demand is going to be at. The same on the manufacturing side, that a lot of what comes into the U.S. in containers are inputs that our manufacturers use in their products. And manufacturing activity is down a couple percent year over year right now. And so that combined uncertainty in the retail wholesale landscape, combined with some slowing demand, and then we know slowed demand, and we're in a manufacturing recession compared to last year. Those two things are pulling volumes down. But effectively what's happened is we've regressed to the long-term average, but that feels like a collapse after the last 2 to 3 years of import activity.
Yeah, and I've read a lot of articles and heard a lot of people speak on this subject, and there's some optimism, no doubt. I don't see it, and I don't think you see it that much either. I mean, because of what you said a couple of weeks ago, that there's no significant boom that's going to change the market and put it in the right direction to kind of reset itself. Right now, I don't believe there's going to be a peak season. I think we're going to fall really flat on our face, and there'll be a lot of disruptions. A lot of carriers, I feel, are going to fall off by the wayside because the volume's just not there. Your thoughts?
Yeah, so right now I don't see much scenario. So on the import side, I do believe 2023 will be a weak peak season. I've been calling that for quite some time. We still have too much inventory, building materials retail. We still have way too much inventory in parts of wholesaling. So apparel wholesalers like Nike are sitting on too much inventory right now. Wholesalers of HVAC and plumbing and supplies of that sort are sitting on too much inventory. So a lot of these import-centric sectors are just over-inventoried right now. So that is going to mean less imports coming in than we would expect, even if demand, is actually still on an absolute basis higher than 2019. We have, excess inventories to burn down. From a broader economy perspective, as I think back to the prior sort of 4 big freight recessions before this one. So 2000 through 2003, 2008 and 2009, 15, 16, and 19. When we think about what got us out of those freight recessions, we get out of the 2000 through 2003 recession by an unprecedented housing boom that starts taking place in 2004, and that pulls so much demand for freight. We get out of the global financial crisis-induced freight recession fairly slowly, but we're really pulled out by hydraulic fracturing activity and a robust agricultural boom, because I think everyone forgets oil was already back to $100 a barrel by 2011. And so we got pulled out by that sort of unanticipated boom. We were pulled out of the 15-16 recession because in 2017 we have the ELD mandate, we have a business tax cut spurring capital investment, we have oil go up, so we have another fracking boom. And then we have the Hurricane Harvey and Irma recovery efforts that drew a lot of freight demand. So we had 4 pieces that came together. Yep. And then we got out of the 2019 freight recession because of consumer-fueled spending on the other side of COVID. All 4 of those situations are essentially shocks to the system that we had no control over. As I look out and think, what is going to get us out of this current freight recession that we're in? I'm not seeing what any of these things can be. Oil prices could go up to $200 a barrel, and we're not going to see that much of an increase in fracking. The oil drillers have said that. Housing activity is not going to suddenly start increasing because the Federal Reserve Board is not lowering interest rates this year. I know some people think they are, but the Fed is clearly signaling they're not going to do that. If anything, I think it's more likely that they actually increase interest rates by another 25 basis points here at their June meeting. So housing's not coming to our rescue. I don't see what gets us out of the current slump in manufacturing anytime soon. And with the consumer being financially strained and also wanting to spend on services and not so much on goods, I'm not seeing the consumer suddenly have this change of behavior that pulls us out. And so my guess is we're in for a long sort of ride on the bottom of this trough, which again, if we go back, that's what we saw in 2001, 2002, and about the first half of 2003. So we've had multi-year freight recessions before. We're very likely going to be in that right at the moment, in my mind.
Wow, that's definitely not good news for sure. And from what I've read, Jason, trend economics, I read a lot about that as well, and they were dead on that. I mean, like I said, all the way through peak season, being very, very flat, coming into the new year, flat, a little bit of a dip before April, and then a rise in that. And it kind of falls in place with what you're saying as well. What can be done here as far as the supply chain to kind of correct that, if there a correction is going to be made where there's some type of profitability, if anything, out there that's going to keep businesses afloat, carriers afloat, and keep people employed?
Yeah, so I think from a carrier standpoint, this has been where right now the one challenge that we're having is the data that we have, sort of the most complete data on employment at truck transportation establishments, is not yet showing a substantial fall off of overall trucking employment, which is very surprising. Now, we've seen it in, let's say, the less than truckload sector, where we've seen payrolls decrease by about 10 to 12,000 from the peak that we saw in 2022. But we're not seeing that capacity exit yet in the type of, or in the quantity that we would need to correct the market. So then that creates a question of what are carriers to do? The biggest thing, I can give advice for is conversations that I've had with quite a few small carriers, is the ones that are still doing well. They typically are anchored to a small number of shippers. They've really tailored their services to those firms. And that's where they get their head hauls, and they use load boards, use brokers for the back hauls. But what I'm seeing right now that really tends to differentiate the firms that are doing well versus those that aren't are whether you have a solid shipper base of contractual freight. That your small 2-3 power unit carriers that have those good, consistent shippers, they're doing okay even in the midst of this freight recession. It's the carriers that were founded in 2021 to only chase spot loads. They're the ones that are hurting.
Yeah, and let's face it. During the pandemic, a lot of carriers made some good money, and hopefully they banked on that. And we've had conversations about that, and I don't know. I hope that they're still financially sound and they didn't spend all their money foolishly. And to your point, that they're looking to get ingrained into these shippers where they can be there for each other and not look for the dollar and be chasing that dollar, because the dollar right now doesn't exist. Everybody right now, Jason, I'm not trying to preach to the choir by any means, but they're going to the depths of hell, and they're chasing that rate, the cheapest rate to the bottom, which I won't do. And the thing is that what's going to happen on the shipper side, and I feel strongly about this, is that the loyalty is going to be lost. They're going to start asking each other, hey, what have you done for me lately on the carrier side? And what's not being asked from the shipper side is, hey, what can I do for you to help you to be better than where you are right now? And I think that's a conversation that needs to be had. So if you were going to give advice to brokers out there and carriers, let's go on the broker side right now. What kind of advice would you give them when they're talking to their shippers and their prospects about the economy, about the supply chain, and what they can do to try to help them be better than where they are right now?
Yeah, so I think the question of a broker, especially if you're a smaller outfit, is just understanding your niche and understanding where within your, well, say, clients' networks do you deliver the most value. If you're a broker, you deliver so much value on those medium to low volume lanes where volume is inconsistent. If it's a high value lane, or if it's a high frequency, short distance shipments for a shipper, they're not going to talk to you as a broker. And you probably don't want that freight because it's short distance.
Right.
And so it's trying to understand, okay, what is my shipper's network of freight? Where can I see that I can deliver the most value by providing you capacity? And typically it's those low to medium value, long haul, inconsistent lanes. That tends to be your home and what you want. And you plan accordingly. So I think that the challenge that I'm starting to see is when I see industry language that speaks to, okay, there's new types of, structures emerging that are going to change the name of the game in the industry. It's like, no, we've seen things like having asset-based capacity and brokerage arms for a very long time. That's what JB Hunt does. That hasn't changed the industry. So I think that it's, especially from the small brokerage standpoint, it's understand what is your place in this ecosystem and find ways, again, how can you deliver value so you can get that freight on a contractual basis and also price it accordingly. Right now, if you're a broker, it's not hard to obtain capacity, so watch those margins. I think from the carrier standpoint, again, it's figuring out, again, if you're small, what is your niche? How do you find a way to provide value to that shipper that is unique? And I think too, it's also, I'm going to tell you, I've done research. I've looked through tens of thousands of trucking companies' websites, and I do not exaggerate. I bet you half of those, I have no idea what you actually do. Or we go everywhere in the United States. It's like, I bet you that you go between some origin and some destination a heck of a lot more often than that. It's not like I'm randomly throwing darts at a wall. Convey what your strategy is. Convey what that is to brokers. Convey what that is to shippers. The best carriers out there from a marketing standpoint, I can go to your website, it looks decent, and you say, hey, I specialize in hauling auto freight in Michigan, Indiana, Ohio, Kentucky. Okay, I'm a broker and I've got a tier 1 auto supplier with a plant in Ohio. I may give you a call. And so I think that it's little things like that that just help you differentiate yourself. Again, you can't be all things to all people,
No.
But I think that that's the tendency that we have, is we want to please everybody. And in doing so, we're not best of breed at anything.
Right. I think, and I've said this on podcasts, and even when I was co-hosting a podcast, that brokers seem to work from the outside in. And I believe that the strongest advantage of any broker out there or service provider is working from the inside out, because that's where the rubber really hits the road. That's where the supply chain issues manifest themselves operationally, processes. I could just keep going on and on and on, where the simplicity on the carrier side and giving rates and quoting freights and moving freight. Although it's hard, I believe that, but I think that collaboration is missing. That understanding, that mutual understanding between the two entities that are trying to build partnerships isn't existing as much as it should be. Do you feel from, talking to brokers, carriers, looking at websites and everything, do you think that's missing? And do you think that is important to building those type of relationships in this type of market?
Yeah, no, I think the challenges we have is everybody tends to have short memories. I mean, the market goes up like it did in the back half of 20 all through 2021. A lot of carriers let their contractual obligations to the side because they allocated their equipment to the spot market because they're making 30-40% premiums running the same lane. And now they then find themselves in a situation where that shipper's saying, either I don't want to give you capacity, I don't want to invite you to the bid, or I really want a price decrease because your service is poor. Shippers the same way. Oh, we're in, back in 2020, back half of 2020, all of 2021. We want partnerships. And now we're going transactionally as low as we can possibly go, given where the spot market's at. We're going to push down our contract rates because the CFO is telling us we need to cut our transportation spend by 25 or 30% this year. And so I think the challenge is there's always this short-termism focus on either I'm going to get while the getting's good, I'm going to take that high-paying spot load, or conversely, I'm going to just hammer it to the carriers when the market's down, to try to get back on that. And eventually the market will turn. I don't know when precisely it'll turn. I think 24 is a reasonable guess, barring, again, something unexpected. And we'll go through the same routine that we always go through.
Yes, absolutely. And, you know, when they do RFPs and everybody's chasing, cheapest rate out there, loyalty becomes a big, huge issue. And when shippers need carriers and they're not there, so forth and so on, I feel that they lose a lot of money, especially on the back end of the business when the SG&A cost and how much it actually cost them to do short-term RFPs. It used to be long-term RFPs for an annual contractual agreement, right? But now you're seeing those short terms in 3 months, maybe 6 months. What are your thoughts on that? Should they continue doing that or ride the wave and be there for the shipper for the long term to build those type of relationships?
So I think a lot of that depends on how stable the network is from a shipper's perspective. Um, I think the one improvement I'm seeing is rather than, me bidding out 10,000 lanes, of which 5,000 of those have like 4 loads a year or less on, right? Is we're now starting to see a realization that, hey, 20% of my lanes probably account for 70, 80% of my freight. I need to be bidding that out at least at minimum annually, maybe every 6 months, depending. Um, that's the stuff that should be going out for bid. To me, the one big improvement is for this low volume inconsistency stuff, it's 1 load a month. Just put it on the spot market and be done with it. I mean, why go through all this transaction costs, like you mentioned, to have to bid this stuff out? Because what's a carrier going to do? Oh, 1 load a month. Okay, here's my backup rate. I have no intention of honoring that if there's something better in the market that I can get at that point in time. So you're getting a contractual rate for which there's no binding sense of obligation whatsoever. So I'd say that's where I think we have the opportunity for improvement. When routing guides are falling apart like they were in 2021, as shippers, you have to, do the mini bids and get the pricing on those lanes up to a market price. I think transparency with carriers is the key thing. This is why we're doing this. I think there will be a lot of hard feelings from 2023 on the other side of things, the same way there were in the back half of 21 and the first half of 22 in the other direction. I'm hoping that the extraordinary run up and now run down in pricing is a once in a generational event. And hopefully we don't go through this type of extreme volatility as we, see. My belief is I really think we're getting close to the trough, if not already in the trough of this market cycle. But as we go up, things are much more muted, maybe feels a little bit more like 2017, 2018, or even 2013, 2014 in comparison.
Yeah, I mean, seasonality. We've all been through it. You have your peaks, you have your valleys. This is this is definitely under the weeds kind of an economy right now, especially in the freight market. Um, I've gone through a lot of different seasons in my career, and I'll tell you, I haven't seen anything like this. Even with my memory going back, to 13, the eights, and 2019, this just seems like a whole different animal. That we've never seen the likes before.
We've never seen the year over year price decreases that we've seen now. There's no doubt, like the Bureau of Labor Statistics, their producer price index for general freight trucking, long distance truckload, which is the government's way of saying dry van, is down 19% year over year as of April. Now that's including fuel surcharges, but that is by far the biggest year over year decline we've ever seen. We also saw the biggest year over year increases ever in 2021 and the early part of 22. So from a rate standpoint, we've never seen a run up and now a run back down like this. From a total volume standpoint, by far the worst crash was 2008, 2009. We lost something like 22, 23% of trucking activity between the latter part of 2007 to June of 2009. We lost about 20% of trucking activity.
That's a huge number.
Oh yeah,
I
yeah.
mean, when you think about that, and everybody was mentioning about the bloodbath. Are we going to see a bloodbath? Through this, I don't know how much longer that the carriers can hold on to this. I hate to say it, but I think we're going to see a lot more carriers exiting the industry if it keeps on going for another 2 or 3 months. I mean, I just don't see the sustainability. Well, your thoughts on that?
Yeah, so I think the ones we'll see exit will be the young carriers. So the one thing, actually, some of the academic research I am doing now focuses specifically on this, is the factor that predicts most strongly carriers exiting is not size. We often talk about size, but it's not size. It's not even close. It's the age. And a carrier that is, 1 to 2 years old is over twice as likely to go out of business as a carrier that's even just 4 to 5 years old. And once you get 6 to 10 years, you kind of flatline and there's really no effect. So once you're established out there, 7, 8, 9 years, your age doesn't matter at that point. So what we're going to see is we're going to see a lot of young carriers and especially carriers that have low productivity. The one overwhelming finding we have in economics from dozens of studies using the universe of data from different sectors, whether it's manufacturing, whether it's retail, whether it's wholesale, is one of the most powerful predictors of going out of business, other than age, is how productive you are. And so what I'd be telling every carrier right now is think about productivity and how do I maximize that dollar per employee effectively coming in? And that's what you have to be thinking about. How do I maximize that revenue productivity? Because that is what predicts failure above and beyond, how young you are. And so I think what we're seeing and where the conversations come in is, if you're a small carrier, you have those contractual relations with shippers, you tend to see that revenue productivity being a little higher because the rates you're getting are a little bit more consistent. They're not going to be driven down as low as, let's say, the spot market. And it's consistent freight. You keep your trucks moving all the time. And so I think the challenge we're seeing is so many carriers that could be very inefficient in terms of the loads they were hauling, maybe with a lot of deadhead in between, because rates were so high in 21 and the first, quarter of 22, are now going to be the ones finding themselves facing the biggest predicament.
Yeah, and I think what happens, and it's been going on for years. I've seen it when I was on the shipper side, is that some of the carriers, you're talking about the one-offs and stuff that only moves maybe 2, 3, 4 times a year, and they're taking it on even if it's like once every 2 weeks or whatever. and it's going into like god awful places like the Upper Peninsula in Michigan, out of New Jersey, and their OR ratio is like 121, and they're trying to be profitable, and they take it on as saying, well, we're trying to complement the account. Well, no, you're not. You're not trying to complement the account by taking that god awful lane on. You're actually hurting yourself, and you're hurting yourself bad, because when you look at the overall operation ratio, that's drawing you down. It's up to traffic managers to find that niche carrier, like you were saying, who goes into those areas and that can service the heck out of it, and do a very, very good job. And then focus your point on the carriers that go into these certain geographical areas that you said before, that where their profits are the greatest, to keep them afloat, that's going to service the needs of the shipper. And I think that's what a lot of traffic managers need to do, a lot of brokers out there need to do, is to start really looking at their overall clientele, where they're located, the carrier base that they have as a pool for that specific carrier, and then start adjusting them, like you said, to be more profitable. Get them into the areas that they go into. Don't force them into areas, or if I'm a carrier, don't go into those areas just to keep your equipment moving, your assets, because you're going to be losing. It's not a wise move. I think that's exactly what you said as well. So your thoughts on that? I mean, should they be doing that too?
No, they shouldn't. I think this is where it's incumbent on the carriers to be, again, very clearly, especially if you are a small outfit, what are the lanes, that you can service most profitably? What is your freight network look like that you haul? And I think that that's one of the big challenges is, again, a lot of carriers may not want to even say that because they're worried about losing business. But my statement is, as an academic, I have a 3-year backlog on research I'm planning on doing. I have to turn projects down all the time, and they'd result in publications, which is the currency of academia. But I have to ask myself, what is it that I'm best at? Where is it I get my biggest return on investment? I think every carrier out there has to think the same thing. Given my network, given where I'm domiciled at, given where I live, what lanes do I want to be hauling? Given the balance of freight, how can I get from A to B, B to C, and then back to where I'm at? How do I set that up? And how do I clearly convey that message? How many new entrants really have no understanding of what their cost structure is. So they don't know what makes sense for a good bid. And so I think that that's where, again, there's just so much room for improvement. And the great thing is compared to 20 years ago, we have so much more data out there to inform these decisions. Go back to 2004. If I'd ask you, hey, figure me out a spot rate to go from, I don't know, Cedar Rapids, Iowa, down to, I don't know, Savannah, Georgia. Good luck finding that, right? Versus now, going to DAT, okay, I'll take a look at the last 3 years of what the spot rates were. We have data availability like we haven't ever had before. Is how can we best leverage it? And to me, it's not this, big data analytics, people coding in Python and doing all this other type of stuff. It's just literally, can I just find data on what rates are and then start ballparking where I think I should be at?
Yeah, it's the old saying, data rich, information poor, right? You have all that data, but are you reading it well? And how are you slicing and dicing it to make a lot of sense out of it? To take that information, if you get that, if you know what you're looking for, and give that to the shipper or the prospect. And I'm a firm believer, there's no other better data than the customer's data and the history of their shipping on the peak side, on all the season, 3 months, January through March, September through November. When you're looking into all of that, you're taking everything into consideration. You're coming up with some kind of an idea as far as the fluctuations in this market. Not really that much, but I think that's the biggest problem out there, that there's a lot of data out there, but the information is just poor.
Yeah, no, I would agree. I mean, I always tell this story of one carrier that I'd worked with that got themselves in the auto space. And nobody checked and realized that the month of July is when the automakers change over all the lines for the new model years. And so they're like, oh my God, volume has collapsed. We're getting 15% fewer tenders. It's like, calm down. They do this every year.
Right.
And it's like, well, what do we do? It's like, housing is usually humming in July. I mean, it's like there's alternative shippers out there where July is a really good month. The auto sector, it's a bad month, but guess what? They're going to ramp up like crazy in August and September, so you all better be ready.
Yeah, absolutely. So I got two more questions for you, and then I'll let you go. With the mass, I'm calling it a mass exodus from the port of LA, going into Houston, going into Savannah, going into New York. Is that going to be sustainable? And will Long Beach and LA recover from the massive disruptions? Because I feel a lot of shippers out there just got fed up and they started moving their shipments and their inbound freight into the Houston market. It was up there I guess it was like 24% not so long ago. But what are your thoughts on that? Are they going to recover, or is this something that we're going to continue to see in the very near future moving forward?
So right now, give it some time. Could we see some market share clawed back maybe a little bit for, let's say, East Asia imports heading to the U.S.? Once we get a labor contract, then it starts becoming possible. But I think long-term wise, we've been in a secular downward decline in the percentage of imports from Asia that go in through the West Coast ports all the way back to the early 2000s. Essentially, since we normalized trade relations with China, the secular trend has been a little bit away from the West Coast. So you could say that the East and Gulf Coast have been growing more rapidly than those two. I don't see, I think probably 2021 and the first half of 2022 could end up being peak import volumes for LA and Long Beach for the foreseeable next decade. I don't think that's unreasonable, looking at just sort of the historical trend we were at. Again, the more things shift to Mexico, the more that hurts them. The more we shift away from China to, let's say, India, that does not help the West Coast ports. And when you start seeing, too, the investments that many wholesalers and retailers are making in terms of building, inbound cross docks and break bulks and all these type of facilities, transloading points in Savannah, in Houston, in New York, New Jersey, these are permanent changes. You've got this giant fixed investment. I'm going to be slamming my freight through those. So I think the West Coast ports will have permanently hurt themselves. They never, from a percentage perspective, the only year where we saw an increased percent of freight coming in through the West Coast relative to the East and Gulf was 2020 compared to 2019. And that's because we were rushing everything over from China during the pandemic. So they've not helped themselves at all.
Yeah, I mean, we definitely saw that. We definitely saw that coming. I mean, just the influx of everything that was coming in. I don't think, I'm a firm believer in looking at the what ifs and being more proactive, have a proactive mindset than a reactive one. Because if you can think about the possibilities and try to get everything you need into place, whether it happens or not, you're going to be ahead of the curve, at least the way I think, then have it happen and then going into reactive mode where you're just throwing anything that you can to try to resolve the issue, which may be beneficial and most likely not. What are your thoughts on what if scenarios, and should people look at them?
No, you certainly should. I mean, the once in a century pandemic is something that we never really could have planned for, combined with the fact that really so much of the behavior that was disruptive to the freight network was the government stimulus efforts. Like, we've never seen, essentially every adult get handed a $1,400 check, which is what happened in March of 2021. And so we've been through scenarios that you could not, if you would have went to somebody in 2019 and said, I want you to plan for this scenario, they would have laughed at you. I think the scenarios that the two that I tell folks you do have to plan for right now are, one would be the Ukrainian war getting even hotter, in particular, a nuclear weapons start coming into the picture. Like, that is a doomsday scenario, but I do not think it's unrealistic. If Ukraine breaks through in the Zaporizhia region and Russia feels that Kherson and the Crimea are cut off, do they think about using tactical nukes? At that point, NATO's in the war, and we don't know where that's going. The other is China and Taiwan. Like, that is the other sort of known geopolitical scenario you need to have some type of plan for. And again, that is one of those doomsday type of events. The economy is going to be instantly in a recession if that takes place, everything that isn't the defense sector. But I do think that that is something that has to be strategically planned for, because it's a non-zero probability event.
Yeah, something that you really don't want to think of personally, but like you said, it's not out of the picture. Anything is possible nowadays, the way the world's working, which, isn't that good. But, I appreciate you spending some time with me today, Jason. I know that you're extremely busy, so I appreciate it. And I hope that in the very near future, you'll come back and be a guest again.
Absolutely. I'd love to be back on.
Perfect. So thanks again. And I'll talk to you soon.
Sounds great. Take care, everybody.
Take care now. Have it. Another logistics life and lesson learned. Until next time.